All right, it is 12:05, so we will go ahead and get started. Happy Friday. Good afternoon, everybody. Thank you all for joining our financial literacy panel. Hopefully, by the end of this, you can all walk away saying that you were able to level up your wealth. So this event today is being hosted by the Professional Development Committee within genKC. For those of you who don't know, genKC is a board within the KC Chamber of Commerce that aims to empower and inspire emerging professionals by offering diverse opportunities for professional development, community engagement, and networking. We are very excited to be able to host this event today for you all. Before we get started, we'd like to give a special shout out to a few of our sponsors. J.E. Dunn for being our title sponsor, and Brian, Cave, Layton, and Paisner for being our professional development sponsor. Now on to our speakers. We have three amazing panelists ready to dive into their respective topics today. If you haven't already seen, we have Jake Scarbo from Academy Bank, Shannon Berry from American Century Investments, and Jessi Chad from Aspyre Wealth Partners. Go ahead. I'll let each panelist introduce themselves further once they take over, but before we begin, I want to provide a quick overview on the flow of today's session. Each panelist will speak for about 10 to 20 minutes, and following each topic, we will have a brief 5-minute Q&A session for any immediate questions that any of you may have. All questions should be sent in the chat so that we can keep a good pace of time, and at the very end of the session, we will open up questions for all panelists. Once we get to that point, when you are typing your questions, specifically call out which speaker you would like to answer in your message so that we can delegate accordingly. Sorry about that. Just so we can get through and hear all of the information, please make sure that you're muted throughout the session. And then lastly, next week, more than likely Tuesday, we'll be sharing a post-event survey along with the recording so that you can watch it all back, because why would you not want to? And now I guess we can go ahead and get started. So now on to the fun stuff. Jake, take it away.
Everybody, good afternoon. My name is Jake Scarbo. I represent Academy Bank, and my slice of this financial pie that we are serving you up today has everything to do with home financing. I am a mortgage professional, and I do want to start by thanking the genKC team for putting this together. It was a very successful event last year, and I was honored to be invited back for this year's panel as well. I don't know if you caught it right before I sat down, but the light in my office automatically went off, so hopefully that doesn't happen in the next 20 or so minutes. But we're gonna hope for the best. If I have to wave my hands to turn it back on, we might just have to do that. So let's dive in. Okay. Here's some contact information, just kind of about myself. I primarily do everything from my cell phone. It's just kind of what comes with the job. I've got my email, a couple of social media handles on here as well. The QR code that you see on your screen will pop up. An email to me. Yes.
I think you might need to share your screen, unless I'm the only one who's not seeing it.
There's you. There's this. Are you tracking?
Yes.
Great.
Yep, there we go. Perfect.
Wonderful. Thank you for not letting me get too far into that.
Of course.
So here's my contact information. As I was saying, I've got my cell phone, email, a couple social media handles there. The QR code that you see on the screen will pull up a direct email to me if you have any questions that maybe don't get answered in the chat, or if you think of something, or if you want more of like a personalized question to be answered, whatever, feel free to email me. One thing is my license is federal, so I actually can lend in all 50 states. I am here in Kansas City. I live in Lee Summit. These are a few things that I have kind of built my career around, helping veterans. We've got special things for like law enforcement, nurses, first responders, educators, stuff like that. You'll see here in just a minute, some of my background is spent in the mortgage operations side of things. And so I take a very educational approach when I work with people, which makes me a good fit for first-time buyers, things of that nature. We've got all the big three, if you will, which is conventional financing, VA, and FHA home loans. And then we've got some like specialty products, things of that nature as well. Some personal background of mine. I did grow up in Blue Springs, on the south side of Blue Springs. After high school, I went up to Northwest Missouri State. I played football up there for 5 years. I took a redshirt year. My claim to fame is that we did win 2 national championships while I was up there. My senior year was 2013. We ended up winning it that year. I came back to KC afterwards. We spent about a year in like the Waldo area before we decided to jump back into the suburbs. We ended up landing in Lee Summit. There today, I am now a husband and a dad. My 4-year-old is getting ready to turn 5, and then our daughter is 2 as well. Big Chiefs guy. We have season tickets out there. We host what's called Tailgate for the Kids, which is basically we have a big tailgate out there that averages, I'd say, probably 100 people per game. We're out there before the gates open, and we raise money for charity. If anybody on this call is familiar with Hope Kids here in Kansas City, they do some great work. And every year we've raised money at that tailgate that ultimately goes to Hope Kids and their mission. I also sit on 2 different board of directors. There's what's called the Whiteman Air Force Base Community Council, and then the Lee Summit Chamber of Commerce as well. I sit on the board of directors for each of those. Some professional background before we kind of dive into the agenda is, so when I graduated college, I actually had a tough time finding a job. And so I hit up a temp agency, and they were like, hey, we're going to send you to this bank for 90 days. Let us know how you like it. And I ultimately spent like 10 years there. Fell in love with it. The bank that they placed me at specialized in mortgage lending. Like I said, I fell in love with it, and I haven't got out. It just kind of sucked me in, and now I've built my career around it. I spent a lot of time as a mortgage processor. I had some good people, mentors around me at the time. Ended up being an operations manager for a while, all before I came into the mortgage banker role, or like the loan officer role, where I'm working with people more on like a one-on-one basis, technically doing sales. So I did that for about 3 years. Ultimately took a position as the VP of sales at the previous bank that I was at. Long story in there, but I ended up resigning, having an employer change, and now I kind of jumped back into the mortgage banker or the loan officer role as of September of 2023 through current. So it's a little bit about me professionally and my background. Today, here's a quick overview of what we're going to roll through. So equity. We're going to talk about equity and how that contributes to building wealth. We're going to talk about the barrier of entry to home ownership, fact versus fiction. What is real out there? Some common questions, things of that nature that I get. I am, without shame, going to highlight some loan products for you guys as well. Some pertain to us here at Academy Bank specifically, and others are just like the general loan programs that you would see. We're going to go over minimum down payment, credit score requirements. I'll show you a few resources for free credit score, like monitoring, things of that nature. We'll give a high-level overview of just like the home buying process. And then my favorite, we'll show you how to choose the right mortgage for yourself. So that's kind of what we're going to talk about. So let's dive into building wealth via equity. So you hear this word equity, and not everybody may know what that means. So at a very, very high level, equity is the difference between what your property is worth, what is your house worth today, value, relative to how much do you owe on the mortgage on that house. So it's a difference between how much is your house worth and what you still owe on the mortgage. Now, for a very simple example, let's say I own a home that is worth $100,000, and the mortgage balance that I have on my home is at $50,000. That means that I have that difference in there is $50,000 worth of equity. That's essentially what equity is, and that equity contributes to your wealth over time. We're going to dive into that a little bit more as well. I threw on here what is the best time to buy a home. Technically, the answer is now. I know that is probably cheesy, but truthfully, if you look at throughout the entire history of the U.S. housing market, there's only been very rare occasions in which real estate in the United States has not appreciated in value or gained value year over year over year, which is why owning a property and becoming a homeowner continues to remain very attractive for folks. And obviously the reason is equity. So not only are you gaining value in your property year over year over year, just based on the market itself, but if you have a mortgage, every time you make a mortgage payment every single month, that mortgage balance is going down. So not only are you contributing to your equity position based on the market and the value of your property increasing, but every time you make a payment, that mortgage balance is going down. These two things combined, again, makes home ownership very, very attractive for people because it contributes to your wealth. Here is a recent graphic from the National Association of Realtors. I pulled that this week. It has the 2025 estimate on here. And it's pretty compelling. So basically, this gives a view into the median net worth between owners and renters. As you can see, I mean, going back however far, if you're making rent payments, you're paying someone else's mortgage. It's not really contributing to anything financial in your favor, which is why you're seeing such a huge discrepancy. It's like 43 times different relative to homeowners and people that are renting their property. So I feel like this is very compelling, which is why I threw it on here. Again, this ties back to the National Association of Realtors. All right. This one, it's very interesting. I hope you guys can see the screen. There's a lot going on here, so I'm going to kind of talk you through it. A lot of this stuff is more fun fact. So this all pertains to Kansas City, Missouri, number one. There's demographics, there's percentage of homeowners versus renters, there is median household income, that sort of thing. But the reason that I use this is it gives a good view into the forecasted and historical rates of appreciation on a per year basis, an annual basis. Now, everything that you're seeing here ties back to three sources, all blended into what you're seeing. So that's the Mortgage Bankers Association, the National Association of Realtors, and then Case-Shiller, which is just another data source that we use in the industry. And again, I like to use this for the rates of appreciation because it gives you a view into how your investment of buying a home is going to pay off for you over the years and how ultimately that is contributing to your wealth. So if you can see here, Kansas City, the forecasted rate of appreciation from now moving forward to next year is 3.17%, it's great. Now, it's not a Bitcoin or anything crazy like that where you buy in and you see all these crazy gains overnight, right? Real estate is a slower burn, but 3.7% is, again, an annual gain in appreciation. That means your property is increasing in value every single year at a clip of just over 3%. Now, if you look at the historical section up here, 5 years or so, so this is per year, 5 years or so, we're just coming off of COVID, which was, everybody knows that was crazy. 10 years, a look back, 6.7%. Over a 63-year period, a look back is still relatively about 3%. Now, let's take this 3.17% in appreciation. Again, appreciation equals equity gain equals building wealth, right? So let's just take a $300,000 home today. If you take the forecasted rate of appreciation at 3.17%, that means that you're gaining in value $9,510 on your property's value, which means that your $300,000 home today is worth $309 and change next year. Now, this is without considering that you're also making monthly payments to your mortgage. Your mortgage is going down as well. So just to kind of double down on this whole idea of equity, I wanted to share these numbers because this right here, the fact that real estate appreciates year over year over year over year, again, is why home ownership remains very, very attractive, and how that equity position contributes to people's wealth, which is why you're seeing that huge discrepancy when it comes to renters versus homeowners. Okay, barrier of entry. Fact versus fiction. I get a lot of questions all the time, and these are probably the most common. So let's just start at the top. A lot of people think that you need 20% in order to buy a home. Now, why people think that, not entirely sure. It could be because of the second bullet point, where they're just conditioned maybe by their parents or what have you that mortgage insurance is bad, and so you need 20% to put down in order to avoid mortgage insurance. The fact is you don't need 20% to put down. And if you look at the second bullet point here, mortgage insurance is bad. That is not the case. So let's just say, for a quick example, let's say you run a mortgage payment with a mortgage professional, and they say, okay, part of your monthly payment is going to be $150 worth of PMI, or private mortgage insurance. Truthfully, that PMI does nothing for you. It protects the lender, but it's there, and it's part of your monthly payment. So the idea as a homeowner of PMI is not great, but at the same time, let's take $150 annualized. That's about $1,800 a year that you're paying on PMI. Now compare that with the 3.17% that we just saw here, gaining you about $9,500 in equity. So if you cross compare the $1,800 that you might spend in a year on PMI relative to the gain in appreciation that you'll see just simply by being a homeowner, mortgage insurance is more of a tool. It is not bad. It is intended to help people get into homes without that 20% down. So a couple of fictions to start. The other one is credit score. Credit score is 580, so I wouldn't qualify. The fact is a lot of these mortgage programs actually go all the way down to 580. So if you have a credit score of 580 or above, the fact is you're probably going to end up having some sort of mortgage option for yourself. One that comes up frequently, especially with young professionals coming out of school or what have you, is I have too many student loans, or I have a lot of student loan debt, so there's no way that I would qualify for a mortgage. That is also fiction. A lot of these mortgage options, these loan programs out here, have different calculations basically that we use to help people still qualify for a mortgage even though they have those student loans out there. Here's another one, this one right here, where it says, once I save for a down payment, I can buy a house. That one is actually fiction, because, and I will tell you, the number one thing that gives first-time home buyers sticker shock is wrapping their head around the fact that the down payment is truthfully just beginning. Closing costs. I'm sure people on this call are familiar with that buzzword. You hear closing costs all the time. Closing costs actually go on top of your down payment, which typically gives first timers a little bit of a sticker shock, understanding that, okay, I saved up and I have my down payment and I'm ready to go. Well, truthfully, you have closing costs on top of there as well. And we're going to talk about that more in just a second. I wanted to conclude with the fact is down here, guys, that it does take courage to open up a conversation with a mortgage professional. It can seem daunting. I don't know what my credit looks like. I've had some, late stuff in the past, or, I was young and didn't care or didn't know or whatever. It takes courage just to open up and kind of have that conversation. But you never know where things can lead. And when you see things like the difference between renters and homeowners and the wealth gap in there, reach out, have that conversation, figure out where things stand today and maybe what you have to do in order to, become a homeowner in the future. So we talked about barriers of entry. I got Wreck-It Ralph here, one of my boys' favorites, to help us break down the barrier. So I have to come up with down payment and closing costs, not necessarily, actually. So once you have that down payment secured, or if you choose a loan program that does not require a down payment, there are other avenues or other levers that we can pull in order to get your closing costs actually covered for you. We can negotiate with the seller of a property to have your closing costs paid for. The realtor, the lender, can give you concessions or credits to go towards your closing costs as well. Gifts from family members is also pretty common. And then one of my One of my favorite ones is what we call house hacking. So think if you bought maybe a 2-unit home, lived in one side, rented out the other. There's other payment related strategies, something called the 2-1 buy down. The point of me diving into this whole breaking down the barrier is it may seem daunting, the idea of needing to come up with a down payment plus your closing costs. But again, if you have the courage to open up a conversation with a mortgage professional, you're going to find out that there's different ways and different strategies that you can use in order to attain the goal ultimately of purchasing yourself a home. Here's some loan products that I've put together. On the left-hand side, we have conventional conventional FHA, VA, USDA, MHDC, bunch of acronyms in there. These are kind of like the most common on the left-hand side. And the intention here, as you can see the highlights in yellow and blue, is to show you guys that you can get into a conventional loan with as little as 3% down, not 20, not 15, not 25. You can get in as little as 3% down. That's one of actually the first-time home buyer perks. And as you can see in the blue, these credit scores, they don't have to be perfect either. FHA, 3.5%, VA, USDA, and MHDC here on the left all require 0% down. The loan products here that I'm showing you guys on the right-hand side of the screen all are specific to Academy Bank. We have a first responder loan. We have Premier Choice. We'll talk about those in just a second. There's a hero loan and second homes as well as one of our specialties. So the point here, guys, that I want to drive home with you is kind of tying back to the whole Mythbusters slide, where you don't necessarily need that 20% down. You don't need perfect credit, that sort of thing. We can get in with as little as 3. There's 0% down options as well. Shameless plug here for just a couple of our mortgage products that apply to Academy Bank. We have a Premier Choice mortgage designed for professionals joining the workforce. So think resident doctors, somebody that just got their big boy job, is now a doctor working at a hospital, dentist, nurse practitioners, attorney. Think people who don't have a ton of money saved up but are financially on track to earn a good amount. This loan is designed for those types of people who, again, don't have a ton of money for a down payment. You can put as little as 0% down. There's no mortgage insurance, and these are the states in which this loan is applicable. We have a first responder mortgage as well, very unique to what we do here. 0% down required, competitive rates. This one specifically is going to apply to police officers, firefighters, paramedics, nurses, EMS, and then we've got ATF and FBI on here as well. Credit score. So when I talk credit score with people that don't necessarily know what their credit score is, I oftentimes just encourage them to go check it out. There's a ton of resources out there. You can go direct to any one of the 3 credit bureaus, Experian, Equifax, and TransUnion. There's also, credit card companies have, different capabilities in their app to show you what your credit score may be. Credit Karma is a thing out there in the world that's free, and it'll just give you a beat on what your credit score may look like. Oftentimes, it's just good to figure out where things are at. Like if you can go see your credit score or your credit report, you can identify maybe things that are out there that you didn't know about. When I graduated college and I went and pulled my first credit report, there was a $40 water bill from the rental that I had 4 years ago that I didn't even know existed, and it was out there showing as late. And so just small things like that you wouldn't necessarily know to think about. You don't know that it's out there. Just identifying where things are at today will give you a little bit of an action plan. A little bit of an action plan, like, hey, do I need to go clean up this random $40 water bill before I apply for a mortgage? Do I need to pay anything off? Engaging with a mortgage professional, having an idea of what your credit score is, maybe what the credit history looks like. This will, these are baby steps that you can take to ultimately put yourself in a position to say, okay, I've got things cleaned up. Here's kind of the plan that we can take to ultimately put ourselves in a position to purchase a home, build that equity, and contribute to your wealth. Here is a high level of the process. So let's say you did all of that. You followed the action plan, credit score is good to go. You landed your job. Maybe you have a good first conversation with your mortgage professional and you figure out something that works for you. The first thing that everyone should do is you start with financials first. A lot of people get on Zillow and they hit up the real estate agents. They're like, hey, I want to, come look at this house or whatever. And the first thing that a lot of those real estate agents will say is, well, are you pre-approved? Can you get a loan? So it's always good to figure out your financials first. What that looks like is we'll basically set a quick 30-minute call, get to know you kind of thing. We'll go over what you think your credit score is, maybe some steps that you can take to figure that out, and ultimately talk about rate, talk about payment, what's it going to cost you. And once you kind of have that level of comfortability of what your mortgage will look like, that's when we can go through and potentially apply for a loan and work towards your pre-approval. From there, it's you're kind of into the process at that point. Things can move fast based on the homes that you buy. Maybe you fall in love with one quick. Maybe it takes you a while to find the one. But ultimately, working through those financials first is very, very important. And then also staying in touch with your mortgage professional throughout the process as well. These interest rates can move very quickly, sometimes up, sometimes down, all of which impact your monthly payment. So it's good to stay in touch with your mortgage professional as you go through the process. Next, the secret sauce. So how do you know who to do your loan with? This is something that I educate people on every day. Still, as a mortgage professional now, I go through some of this stuff every single day at one point or another. So we're actually going to start with the intangibles first. So the things that you can't necessarily measure: reputation, transparency, expertise, what's their background, what's their communication style like? Do they make me feel comfortable? Am I talking to a used car salesman? That sort of thing. The intangibles are certainly important. The numbers is what we'll kind of dive into here, because I will show you guys basically how to choose the right mortgage for yourself. We'll talk about interest rate, box A, box B, lender credits. So let's dive in. This is an example of an official loan estimate, which is a federal document that every single lender out there has to use. There's a lot going on here, but there's only a few things to truly pay attention to. So first of all, up here in the top right, you've got your loan term, fixed or adjustable rate. You've got your rate here, very obviously in the front of the page. And then you have escrow. What is escrow? That's another kind of buzzword that comes up quite a bit. Escrow, as you can see here in the projected payment section, you have principal and interest, you have mortgage insurance, and you have estimated escrow, all of which combined come up with your estimated total monthly payment. Okay. And then down here at the bottom, the number one mistake that people make while they're shopping for a loan, when they're talking to different lenders, trying to get the best deal and everything, the number one mistake that people make while they're shopping is they look at this page here and they look at the very bottom where it says estimated closing costs. Now, you probably think, well, what do you mean? Closing costs are important. Jake, you're crazy. Of course I have to pay attention to the closing costs. Yes, you absolutely have to pay attention to the closing costs, which is why the most important thing outside of obviously your interest rate as you're looking at this thing is the second page where it says closing cost details. Now, box A, this is what the lender is charging you for the rate on the first page. If I were to tell you guys that there is one thing that is most important outside of the interest rate itself, it is this loan estimate, page 2, box A. Remember that for whenever it's time to go shopping for a house. This is what the lender is charging you for the rate on the first page. Box B here, these are a bunch of fixed costs that basically is just needed to do a mortgage. We're going to do a flood certification to figure out if the property that you're buying is in a flood zone. We're going to verify your employment. There's typically an appraisal done. So these are fixed costs that you really just don't control. It's just needed in order to do a mortgage. Down here in box C, kind of the same thing. And then over here, there's one line, guys, on this page. It's called lender credit, and it's any kind of credits from the lender that maybe that perhaps can cover some closing costs for you. Now, let's do side-by-side comparison. Now, this here is intentionally ridiculous, but these are real live examples. So as you can see, this is the page 2 of your official loan estimate here. Every single lender out there has to use this document. We talked about box A being most important outside of the interest rate. And then I went and put 2 of these box A's right next to each other to again show you an intentionally ridiculous difference between lenders. As you can see, this one over here, box A origination charges $24,000 relative to this box A over here at $3,900. This box B, $2,900 relative to this box B over here at just at $11,000 or $1,100 bucks. So again, I'm showing you this because as you get out here and we're looking to build wealth and we're looking to dive into home ownership, we've engaged with a mortgage person and we figured out the right loan program and we're pre-approved and we're ready to get going. When it comes down to actually looking at the closing costs, it's very, very important because unless you know what questions to ask, maybe you wouldn't question this stuff, right? I see it all the time. And so again, intentionally ridiculous example here, but it's very important to actually look into the details and ask the questions so you're not overpaying for something that you could get elsewhere for a lot cheaper. Here's my final slide. This kind of just concludes the portion that I have for you guys. Again, contact information. I've got a couple social media handles on there and then the QR code. If you have any specific questions for me, I'd be more than happy to help. Just to conclude, thank you again, genKC, and I am open to any questions at this point.
Awesome. Thank you very much, Jake. Let's see. I'll check the chat here. We have a question from Angelica. So what portion of a home's appreciation reflects its true increase in market value, and what portion is simply a price adjustment due to inflation?
Can you repeat the question?
Yeah, of course. What portion of a home's appreciation reflects its true increase in market value, and what portion is simply a price adjustment due to inflation?
The price of a home or the value of a home is truly what someone is willing to pay for it, but really only to a certain extent. And so when I'm advising people who are out here shopping, a lot of the times I will go and dive into those weeds and look at that forecasted rate of appreciation, and we will cross-reference that with what you might be considering spending maybe above and beyond an asking price. Like this is a good compass for those who potentially bought. I don't know if anybody here was familiar with the market back in like the 2020, 2021 area, but these homes were going on the market for $300,000 and then being sold for $320,000, something crazy, $20,000 over what it was asking for. So I think a little bit of your question is kind of getting into that. Now, where I can come through as a professional is looking at that forecasted rate of appreciation and figuring out when is that going to be a negative return for you. Maybe it makes sense to pay $305 based on the rate of appreciation that we'll see over the next year. But if you want to go and offer $320, you need to understand that you're spending more than that house is probably worth at the time. And we ultimately financially figure out whether or not that makes sense. Hopefully that answers your question.
Awesome. And then just to keep on time, I'll ask the other question that we have in the chat, and then we can move on to Jessi, or not Jessi, Shannon. What are the top 3 questions to ask before getting a mortgage loan?
What is your interest rate? Is usually the first one. No, probably the number one question is just about what are the rates doing? I get that almost every day. And really, it comes down to what someone is comfortable with financially, which is why it's important to engage with somebody to do a complete top to bottom review of your finances, how much you have in savings, how much you're earning, how much is heading out the door from a debt perspective, to figure out, is it the right time, or do you need to wait? Do you need to work on a few things before we dive into purchasing a home? And so I guess the top three things would be tough, but I would say just people are just curious as to, like, I don't know what I can do. I don't know if it's time. Help me understand just as a whole when I should be doing this. What does it look like? Is my particular situation a match for being a homeowner? And that's where I can come in. Great
Awesome.
question.
And I see those are all the questions that I for sure have asked, probably too many times. We have one other question from Frank. Justine, can you note that down just so that when we come back to the final Q&A, we can ask that on the back end. But just for time, thank you again, Jake. Really appreciate it. Very insightful. And I think now we can give it over to Shannon.
All right. Can you hear me?
Yes.
Perfect. Perfect. Hi, guys. I just wanted to run through some thoughts here. I don't have a presentation, but I think between the two presentations, there will be quite a bit of overlap between my comments here. So I'm Shannon, everybody. I'm a senior investment analyst at American Century. Honestly, most of the time when I tell people what I do, they have no idea what that means. I have an uncle who every time I describe my career, he would say, that sounds like something that the CIA used to describe their career. And that is not what I do. I am not in the CIA. I am, though, in the financial markets. A lot of times people think of like Wolf for Wall Street or those types of movies. I'm related to that, but it's not nearly as sensationalized as it is on TV. And what I do is much more fundamental and deep analysis on different companies. What I do is basically when you go and you decide where you're going to allocate your savings, either between getting a house or different investment options, I'm the person that actually picks the companies that go into the mutual funds that you are maybe putting into your different investment options, right? I spend my days following the stock market, researching small cap consumer discretionary companies. I say all that to say, like, I spend all my time doing that. I spend all of my time thinking about how is the market going to perform, the interest rates, these consumer discretionary companies. And so because you have someone like me, like Jessi, like Jake, you don't have to. And that is my message here for you today. My message here for you today is for ways that you can take the pressure off of setting up your investment strategies going forward. So I am not an actual financial planner, as I just described. So these are just my hot takes and my words of wisdom. But I think they will serve you well and set up for a good continued conversation. Okay. So with that intro, here's the first thing I want to communicate today. The best strategy I can give you for setting up your investment life is pay yourself first. Pay yourself before you pay anybody else. And preferably make it easy to pay yourself. So what does that actually mean in real life? A lot of times when I listen to Jake's presentation or when I listen to different financial goals that people have, they come at it from a position of, I need to increase my willpower and my determination to save more and control my spending. And there are a lot of places in your life, maybe when you're saving for a house or different goals, that you probably do need to do that. For the most part, though, it is way easier to just take that money off the top before you even get it, before you even just have to decide what else you want to spend it on. What I recommend and what I've done my entire career is before it even hits my bank account, it is ciphered to the things that I need it to go to, for my longer term self, for my future self. Because practicing those moments of willpower over time gets hard. So make it easy. The other ways that this can look like, though, I know I'm on with a lot of young professionals, is, what often happens is as your income increases, your lifestyle increases. And so you kind of are like in this position where you're like, well, I thought when I was making more money, I would be able to save more. And you don't understand why you haven't been able to. Well, A, you didn't pay yourself first. B, there's another strategy that you can do to do this. When your boss comes in, they're like, oh my God, you've done a fabulous job this year. We're going to give you 10% more. You were making I don't know, $1,000 a month. Now you're making $1,100 a month. Instead of just celebrating the extra $100 that hit your bank account, before you even get that raise, put 40% of that raise in your savings. So bank your raises. And Jessi has a whole line of investments that you can do to walk through. So first, I bank my raises till I can get to my company's match or the federal limits. I max out my HSA. Like, you go through the steps, but make it easy and do it from the top. That's my number. If you don't hear anything else, do that. It will make your life so much simpler. If you want to buy a house in 5 years and you're not ready to talk to Jake right now, but that's an extending goal, set up an account that has $100 that gets put in that account that you never see. And it's so easy to set up for. Okay. Try some of those. Try to find creative ways to pay yourself first. My second thing I want to do is I want to change your relationship with time as it comes to your money. Time is the most valuable asset you have when it comes to your financial life. And for the most part, people do it all wrong. They are way too focused on the shorter aspects of time and don't think nearly as much about the longer aspects of time, right? So let's talk about the shorter end first, maybe. A lot of times what we end up doing is we get wrapped up maybe in the sentiment of the country, or maybe the sentiment of your job, the moment that you're in, the overall economic outlook. They have either elation or fear, and they go into their investment portfolio, and at that moment they start making a bunch of changes in that framework. Very short-term focus. Oh, I think this is going to happen, so I'm going to set up my investment portfolio to do this. Oh, I think this is going to happen, and I'm going to set up my investment portfolio to do this. They forget that there's people like me who think about this all the time, every day, every moment. Okay? So you're stepping into the market on some random day because you're fearful or elated, trying to make long-term decisions. Instead, I would offer you, let's set a rhythm to check in on your financial health. Whether it's quarterly, go in and do a little what's going on, annually, what's going on. And that way you're responding in a rhythmic pattern as opposed to emotionally and sporadically. For me personally, there's some natural spots to do this. You can do this around your birthday. Hey, as a birthday, leading up to my birthday, let me just see this part of myself. Is everything on the up and up? Let me clean up some things. Let me make sure my investments are good. Let me reach out to Jake for to start this conversation about the house I want to buy. Like, have that financial date with yourself, at least annually. Birthday's a good time to do it. If you don't want to do it around your birthday because you're like, I don't want to talk about my money around, do it around the first of the year. That's a great time to do it too. Or if you have a natural rhythm in your professional financial life, you get a bonus for your sales commission at a certain time of the year. Make it make sense. Have a natural rhythm that will dramatically improve your relationship with time on the short end. on the long end, I want you to think longer than you are thinking. Most people, when they think long term, they think 3 years, 5 years. I want you to think long term about your life. Okay. I want you to think over the next 30 years. I'm going to have 2 kids. They need to go to college. I'm going to buy a house. Am I going to stay in this house? I might want another house that's bigger for Sally to have more space in the bedroom. You have to step back and envision your life. Now, this is emotionally important because going through this process starts a manifestation, and I can get on all on that in terms of financial manifestation and how that actually plays out into creating the life that you want. But more than that, financially, it will just set you up to get to the point, and this is the other assignment I have for everybody, to come up with a number that is a hockey stick out there, a goalpost out there to work towards. So when you do your annual date with yourself, you have something that's like out there that you're making progress with, right? Now your number doesn't have to be right. It doesn't matter. It's a goalpost to work towards. But it is a fruitful exercise to sit down and think through how much is it gonna cost to live the life I want to live and do the things I want to do in the next 30 years. And if you go through that exercise, you'll come up with a number. Put that number on your financial annual date sheet. And it's just as a reminder of the life that you're manifesting, both physically with the money that you're saving, and then emotionally with just going through that process. All right, and then I have one last thing to leave you guys with. Change your relationship with time. Get much more long term, much less short term, and pay yourself first. And my last thing is don't let perfect get in the way of good. So if you have 30 minutes to go change your HSA allocation to increase it, but you don't want to do that because you want to think through a whole investment policy, that is perfect getting in the way of good. Okay? Go out there and just do the thing. Just do the one little thing, and that thing could make you $100,000 over your course of your lifetime. So it's okay if you're not maxing out whatever. It's okay if you can only do $100 versus $150. Just do it. Don't let perfect be the enemy of good. If I can leave you with those 3 things, I will relinquish my soapbox and open to any questions. Jessi, you're up, I think.
I think we have just a few questions, but thank you, Shannon. I wish we could have given you I think we could have given you a whole hour and a half, and that would have been the most insightful hour and a half of my day for sure. But I think we have one question in the chat so far. What did your career path look like, and what education or certifications were required to reach your current position? And do you have any financial books that you would recommend for any of us early development individuals or early career development individuals?
Okay. I'll think about okay. I'll answer the first question first. I'll give you my quick bio here. I saw the jig did it and I didn't. I felt bad. Okay, so I've always worked in investments. I've always been an investment. I've always been an equity stock picker, basically. I did my undergrad at Harvard and got a degree in econ. I got my MBA from University of Texas. Again, was always in this career. And I'm also, in addition to being an MBA, I'm a certified financial analyst, which is a distinction that you need to get, or you don't need to get, that is recognized in financial circles. So I'm a CFA, MBA is my official accreditations. And what books would I recommend? There's so many good books. And admittedly, a lot of the books I've read are very technical. But what I would offer is just actually and he's no longer officially, portfolio, managing his portfolio. But Warren Buffett has some great foundational investment books. I think one of my MBA assignments was to walk through the essays of Warren Buffett and outline them, just as a foundation of. So that's a great place to start. I don't always read finance books, but that's where I would point you to.
That's fair. I don't think I read enough books, especially not financial books. But one more question from Samuel. Do you recommend maxing out a Roth IRA plus getting maximum 401k contributions from employer before exploring other investment options?
So here, Jessi's going to be your better option, but what I would always say is yes. There is like an order that is preferred in terms of what accounts um, you fund first. And so yes is my short answer, but again, I'll let Jessi kind of build up on that.
Perfect. And I know we have other questions for you, Shannon. We'll get to those at the very end. So if I don't ask them right now, everybody, please know we'll get back to that at the very end when we open Q&A for everybody. But speaking of Jessi, we'll move on to you, and we'll finish with you.
Awesome. Thank you. Let me go ahead and share my screen. We'll just do a volume check. Hear me okay?
Yep.
And you can see my PowerPoint.
Yes.
Fantastic. Thanks, Sam. Well, I have tough acts to follow here with Jake and Shannon. And Shannon doesn't know this, but she teed me up so well. I think she does know that. I love that you got to hear from Shannon about how she personally is using many different tenets of financial planning. So we're going to just expand upon that in the time that I have with you today. So I am Jessi Chad. I'm a certified financial planner with Aspyre Wealth Partners. I want to just say thank you to genKC for asking me to be here with you all today. I think it's fantastic that we take time out of our day to really think about our own financial literacy and how we can level up our wealth. The QR code that's on my front screen here will get you a copy of the slides. I'll include it again at the end. I put a lot of content on the slides, knowing I wouldn't necessarily have enough time to go through all of it, but it's a gift that I can give to you of some additional things you might think about outside of our conversation today. So we're going to dive in. I love helping people with their money. My goal with my clients is that they feel that they are well with their money and not just good with their money. And we'll get into what that means, but that's an expression that we often hear, right? We say that we want to be, or so-and-so is good with money. But what does that actually mean? It tends to mean that they have good habits and behaviors that allow them to grow their financial wealth. At Aspyre, we see money a little bit differently. We see money actually as a tool to help us live a great life, to help our clients live a great life. So instead of wanting to be good with money, which really just comes down to the basics, I want people to be well with their money. I want to help people avoid injury and illness when it comes to money, since it is such a powerful tool. So today we're going to explore some topics that will help you increase your level of wellness with money. We're going to talk about what it looks like to plan by the decades. We're going to talk about what retirement readiness looks like at any age. Always a popular topic when I'm talking to people who are working hard in their career years, as most of us want to plan on when we can slow that down and maybe pivot away from our careers. And then we're going to just scratch the surface of understanding why we approach money the ways that we do, which I think is the real key to leveling up your wealth. I want to say my planning by the decades is not going to be an exhaustive list. I did make a note to make sure we cover one area that I didn't have in my slides here. But what I'm hoping to give you is some key areas of focus that you can get a sense of if you're on track or not. And maybe some things that don't always come up on the first Google search that you do. So as I mentioned, I'm a certified financial planner. I love financial planning. I have an undergraduate degree in financial planning. I have a master's degree in financial planning, go K-State. I'm certified, and I have been a part of Aspyre Wealth Partners for the last 17 years. I live and breathe this stuff, much like Shannon does in her world. I define myself by my relationships. I'm a wife, I'm a best friend, I'm a sister, I'm a daughter, and my most important role is being a golden retriever mom. That is my son, Walter, and all his glory at the groomer who gets the best pictures out of him. I do not believe that financial planning is optional. I do not believe it's just for the rich and the famous and the wealthy. Financial planning is the key to utilizing one of the most powerful tools that we have access to in our life, which is money, and using that to help you accomplish your goals. I think about financial planning the same way that we think about taking care of different aspects of our health. So before we dive into what does it look like to be on track each of the decades that we lived through, I just want to dive a little bit deeper into this, why it matters to be well with money. At Aspyre, we always like to get really deep on people's why. There's obvious reasons that you want to be well with money. Allows you to do cool things with your life. You can have security, you can feel freedom, etc. But money is this powerful force in our lives, and such power needs to be understood and needs to be managed. Because we've all heard the statistics about how money can rupture relationships. We heard the stats about divorce and finance, money being a leading cause of divorce and marriages. Money has been known to split relationships, split up families, and it also can be this amazing force to living great lives and doing really cool stuff. So I think it's important to understand the impact that money makes. And it's also important to understand that money can be a great stress in our life. So much so that it starts to impact our health, which is why it's my belief that you should care about your money wellness, your financial planning, as a cornerstone and a foundation to overall health and wellness because of the amount of stress that it can cause on the body. So hopefully that is some motivation for us to get excited about financial planning on a Friday after you've been listening to people talk for over 50 minutes now. So if you need to get up and stretch, turn your camera on, turn your camera off, I don't care. But try to stay engaged with me for about another 15 minutes here. And let's talk about what it looks like to have money and good habits amongst all of our decades. So here we are in our 20s. Habits are the key to managing money in your 20s. What I want you to think about here is, Shannon mentioned this, let's get directionally correct. Pick a number, pick a goal. I don't really care if it's accurate. I care that you have one. And I care that we get going in a direction that is going to lead us towards the life that we want to live today and the life we want to continue to live. This looks like having a good emergency reserve. Start with $1,000, get your $1,000, then go up to 3 to 6 months. You may want more than 3 to 6 months in an emergency reserve, considering what industry you're a part of or what your job is. If you lost your job, would it be easy for you to replace that job and replace that income or not? So everybody wants a rule of thumb. I'll give you that 3 to 6 months of your essential expenses. Doesn't necessarily mean all your expenses you would continue to afford in the event of emergency. I want it in a high interest savings account. Somebody put that in the chat I saw. I like Ally Bank, Capital One, Discover, American Express. I mean, so many of them out there now. Schwab. I don't really care which one you use. What I think is impactful here is get it separate of where you have your checking. Out of sight, out of mind, park it over there, put money in it. It's still there if you need it. It's safe, but it's not right in front of your face tempting you. And I want you saving in the 401k. Start with the employer match. I recommend when you're in your 20s and you're at the beginning or first couple of years of your career, hopefully your income is not maxed out where it will be in your 40s and 50s. And this can be a really impactful time to contribute into a Roth 401k or a Roth IRA. The reason for that is because you're going to put money into an after-tax account. You won't get tax savings on it today, but it will grow tax-free for the rest of your life, according to the current rules, I always have to say. So get started. get going in a good direction. The other thing here, and Shannon also touched on this, is this idea of starting to really pay attention to and manage lifestyle. What can happen as we get going through our 20s and our 30s and our 40s is we start to see lifestyle creep. I make more money, then I can afford more things. And all of a sudden, my raises and my bonuses are going to serve my lifestyle. They're going to serve what I want to do now. If you can get in a habit where Shannon said 40%, I like 50%, I don't care whatever percentage you do. Just don't always increase your lifestyle with every compensation increase that you get. That's how you're going to pick up leverage on being able to save money in your 20s, but also later in life. And the last thing I want to point out here is this idea of making sure you have power of attorney documents. Nobody talks about this in your 20s, and we really should be talking about it because nobody has access to your healthcare and your finances once you turn age of majority in your state. And you may need somebody at some point to step in and help you make decisions because you're not able to make them yourself. So in our 20s, we like to think we're invincible. We just want to have a lot of fun, but life happens. So get some power of attorney documents. 20s are for your habit. Your 20s are building habits. In your 30s, it's time for us to get our stuff together. Okay? It's time to adult. You can still have fun. I recommend having fun through all the decades. But this is where I want to start to see that we have a good solid sense of what those short-term goals are, but also our medium-term goals and our long-term goals. Back to Shannon's point about pick targets that are out there. Don't worry about them being perfect. Don't worry about them being correct. Worry about creating motivation for you to work with your money in a way that you give every dollar a job. Every dollar that comes into the ecosystem that is you and your family should have a job, whether that's serving your lifestyle, helping you manage emergencies, funding a short-term goal, a medium-term goal, or a long-term goal. But no idle money sitting around. That may look then like having different reserve accounts. That might look like you getting to the point where you're maxing out your 401k, 403b, 401a, whatever you have access to. The rule of thumb I like here is that you're saving 20% of your income and or maxing out that 401k. And this is the opportunity where as your income is increasing and you're starting to see yourself get into those mid-20 tax brackets, go ahead and flip those contributions to be pre-tax at that time. Or do a hybrid of pre-tax and Roth. So this was asked, and I'll insert it here, this kind of hierarchy of how I should save money. Emergency reserves first. If you have credit card debt, it's likely high interest, you need to get that paid down. Then I want you putting money in the 401k up to the employer match. If you have access to an HSA, go ahead and max that out next. And then you come back around to the 401k and get that up to the IRS maximum. Then we'll talk in the next decade about what else you might add on top of that. But that's my hierarchy of savings. If you have children that you want to help them fund their education, time is on your side here. Let's get those 529 set up early. Let's get those brokerage accounts set up early. Even $50 in it a month is going to make a difference. This is also the time where you should be hiring a certified financial planner and not just utilizing your dad's stock guy. We need to move beyond that. We've got a real life to plan here and probably other people's lives that are starting to get planned alongside it. And then manage your risks. That looks like having proper insurance in place and having estate planning documents that align with your goals. I'm going to move fast through these, so I know if there's questions, put them in there, we'll get them answered. The next we're going to talk about is our 40s and our 50s, and I call these the earn baby earn years. You need to be at the approaching your highest earning potential in your career, in your 40s into your 50s. Why? Because we need to be really hitting those savings goals if we're going to pivot that career at some point, retire. I want you prioritizing your own goals and your own goals around retirement in these years over the kids. Controversial, I know. Here's the thing. There's a lot of ways to pay for education beyond high school. There's not a lot of ways to pay for your retirement. I'm all for educating your kids. I benefited from a mother who believed in educating her kids, but not to the detriment of saving for your own retirement. This is when we also need to be checking back in on that lifestyle creep. Do we want to make adjustments? These are the years to not be making adjustments, because are probably some of our highest expense years as well, but be looking ahead to say, okay, these expenses fall off at this point. Maybe you're getting to where the mortgage is getting paid off. Maybe you're getting to where cars are paid off, other debts are paid off. When that free cash flow comes back into the system, It's no longer going to a creditor. Put it into savings. You're not used to having the money anyways. Also, in your 40s and 50s, time becomes more valuable than money. So use money to buy time. This is when you can delegate things out. This is when you outsource, whatever that looks like in your life. But time will be one of your most important resources in your 40s and 50s. So I stopped it there on the decades. We can address if we've got people in the audience that are in their 60s and go from there. But I want to talk and have enough time to talk here about retirement readiness for all. And this is going to look a little bit different than maybe what you've Googled. For the sake of time, because I want to make sure we do leave enough time for question and answer at the end here, I'm going to hit really hard on one point here. And this is this idea of making sure you have a brokerage fund or brokerage account. So I gave you the hierarchy of savings. A lot of people focus just on saving money in the 401k for retirement. And that's great. And you get a good match and there's great funds investing in there. But it's most likely going to be the majority of it is pre-tax. Meaning when I get into retirement and I start utilizing that, every dollar I pull out of there, I pay taxes on. Now everybody tells me their taxes are going to be less in retirement. And I'm here to tell you they're not. If you've only saved your money in pre-tax ways. So this is where the Roth comes back in. Let's have some after-tax money. But the third type of savings here that doesn't get enough attention is the idea of funding a brokerage account. A brokerage account is simply a savings account that you can buy investments inside of. The reason people don't like these is because the taxes suck. You have to pay taxes in the year that the interest and the dividend gets paid. And then when you sell an asset, you have a capital gain and you have to pay tax on that. You will not go broke paying taxes. In fact, this will leverage you to be able to maybe retire before 59 and a half when those 401ks are locked down and you get penalties if you pull out of them before then. That will also give you leverage when you're in your retirement years to be able to not have everything be pre-tax and to be able to control your income tax situation, which is a way that we do help clients in retirement leverage up their wealth. The other thing I want to point out here that we don't talk enough about with retirement readiness is making sure we take care of our health along the way. That we don't wait until we're retired to get the workout routine going and eat well and manage our stress. Because your body will wait until it can get your attention. And that usually happens the day after somebody retires. The body comes knocking and says, hi, all that high blood pressure we've had the last 10 years, now we're going to deal with it. And I've had way too many clients sit in doctor's offices the first 9 months of their retirement because their body finally demanded the attention. So do not neglect your health along the way. Think of it as readying yourself for the retirement you want to live. I'm going to skip a story that I was going to tell you. So this slide will not make sense, except that what I can say about this slide is this represents my grandmother's wealth. These are items that she has canned for years and years. And we actually moved this from Alamogordo, New Mexico to Lee Summit, Missouri 3 years ago. Why would this story be inserted in a talk about financial literacy? Because this tells me so much about how my grandmother grew up and how my grandmother thinks about wealth. My grandmother was born in 1933. That was during the Great Depression. And one of her earliest memories is eating unsweetened blackberries out of a can. And my grandmother never wanted to eat unsweetened blackberries out of a can ever again in her life. This experience shaped how she thought about money, how she interacted with money, and what she believed about money. So if you ever find yourself saying, why am I like this with money? Whether that's a good thing or a bad thing, one of the most powerful tools you can do to level up your wealth is understand your own psychology around money. I can give you all the tips, tricks, recommendations you need, but it is up to you to manage your actions, your habits, and your behaviors around money. I can't do that for you. What this looks like is if I have a behavior today, if I have a habit today that is not serving my goals, and I'm frustrated myself, let's say I just can't stop spending money on Amazon, then what you would look to do is change the behavior. Okay, I'll delete Amazon off my phone. It's not going to change it. We got to go deeper. We got to really root down as to what is informing that behavior. And this is where we get into what is called your money script. So the way this works is we have early memories with money, usually inside of our family system or whoever raised us is teaching us about money, whether they know it or not. So some things you can ask yourself is, how was money discussed at the dinner table growing up? What was my experience with money as a kid? Because That history has then informed a script, a narrative that you have around money. Most people fall into one of these 4 narratives that are on your screen. There's a quiz that you can take out there. I think it's really easy to self-identify here. You're going to start reading some of these bullets and you're going to say, well, that's familiar. No surprise to anybody, a certified financial planner usually is money vigilant. I have a strong money vigilant money script. Grew up with a mom who was an accountant that showed me how to balance a checkbook when I was 8 years old. That created a script inside of me that now influences my behavior around money. You may say, that sounds like a pretty good script. You're probably doing pretty well. It's true. But what you'll notice under money vigilance, anxiety over money, I worry about money all the time, unnecessarily. To the point my husband asked me one day, will you ever stop worrying about money? And I said, no, I don't think so, because that script is so deep in me, but my goal is to lessen my worry around money. So you may be reading this and thinking, wow, I have a money avoidance script. Why this is important is once you understand the narrative you have around money, you can change it. You can work with it. That's what I did with mine. Is I came in and I said, okay, you're always going to worry about money. It's just kind of in your blood. You have a grandmother that lived through the depression. But I can recognize it in the moment and I can say, okay, that's informing this behavior. Do I like that? Is that how I want to show up with money? So that is scratching the surface of what is money psychology. I'll have a great book that you can read to dive deeper into this. But again, I can't hammer home enough how important it is to understand why you are the way you are with money if you're looking to expand your wealth. Go back to your why. Money is just a tool. It's a great tool, but it's just a tool. Understand that money script. Past experiences do not have to indicate future ones. And the last thing I want to leave you with, the last tip that I have for you is to be your own benchmark. You can go out and compare yourself to everybody around you. Comparison is the thief of all joy. It's true with money. Decide where you want to be. Decide where you want to be in a year, 5 years, 10 years, 20 years. Figure out how the money aligns with that and use that as your benchmark, not what your peers are doing. There's some resources for you. I really enjoy the books by Morgan Housel. He wrote a book a couple of years ago called The Psychology of Money. The one I'm currently reading is The Art of Spending. It's even helping me, who's been doing this for 17 years, really think about spending money and how you get full utility out of it. And I am a big fan of using generative AI as a starting point. Go to chat, go to Copilot, go to Gemini and say, I'm such and such age, help me start my financial plan. But then you got to hire a human because you're going to need somebody to come in and help you customize all those great recommendations you're going to get. And that's where I come in. There's that QR code again, so you can get the slides. It'll take you to a page on my website, our company's website, where you can sign up for a free consultation. I'd love to talk to you. The first hour is always free. You can read our blog and get access to my LinkedIn where we post different content and things like that. So I promised I would be done at 1:15. It's 1:17. I did my best, Sam, but thank you all.
No worries at all. Thank you so much, Jessi. That was fantastic. Very informative. I love looking at the chart that you display. I matched mine immediately. And then I also laughed when you said, don't just use your dad's stock person, because I texted my dad immediately and said, I need to get off your stock friend. So that will be on my agenda this week. Thank you very much.
I'm available
And
to you, Sam.
Okay, perfect. I was going to say this will be easier. I'll just message you on the side. But I'll ask just a few questions directly for you, Jessi, and then I'll just open it up and I'll start asking questions to Jake and Shannon that were asked that we obviously didn't have time to get to. Again, thank you, Jake, Shannon, Jessi. I wish we could have had an hour for each of you. Easily could have. Maybe we'll do that another time. But so for Jessi, do you recommend a high yield savings or a money market account for that savings landing zone that you kind of displayed, I think, in one of the first few slides that you shared?
So all the bankers in the room are going to throw tomatoes at me. This is fine. I like online savings accounts. They have higher interest rates. I recommend high yield savings accounts, CDs, or going to a custodian like Schwab or Fidelity and using the money market mutual funds that they have.
Awesome. And then we have a question from Luis. What do you recommend for those that are within the 5 to 10 years of retirement?
Work with a financial planner. You're going to need help.
Easy.
It's a lot of decisions, but that is the prime time. You're in anticipation of a big transition that has a lot of decisions. You need a good decision-making partner. If you've not started saving into a brokerage account, great time to start doing that. I even have clients take down sometimes their 401k savings to be able to do that brokerage of fund, just if that's the last savings that we haven't got to yet. Your taxes won't like it, but you will like it as terms of leverage in retirement.
Awesome. And then I'll ask one additional question. So, how would you recommend managing investing while also paying off student loans?
Phenomenal question. I would just get started. This is where Shannon's advice of don't let perfection get in the way of good. Even if you're really focused on paying down student loans because of the interest rates, that makes a lot of sense to me, but still get that employer match on the 401k. Still make sure you have an emergency reserve. Even if it means you have to pay down that debt slower, have some of those in place to protect yourself. And then make lifestyle changes in order to pay down debt faster, knowing that once that debt's paid down, then you can give some of that money back to yourself. So I like to think about life and financial goals in seasons. So a period of time, my spouse did not have income for 9 months because they were student teaching. And so we, for 9 months, made changes to our budget, knowing that at the end of that, there was income coming and we could bring some things back in. So it doesn't have to be your forever.
Awesome. Thank you so much, Jessi. Really appreciate it. Now I'll just kind of start asking questions as they were tailored to each individual speaker. I think there was one question that went unanswered, one or two questions unanswered for Jake. Jake, could you explain how mortgage loan experts typically structure their fees?
Yes, it's gonna differ on type of lender. So there's like I work for a bank, for example, and there is also a mortgage broker. A broker is typically going to uh, charge like be compensated by their client in one way, shape, or form through fees, whereas the bank is going to compensate me without as many fees that are in there. So I don't know if that truly answers your question, but it's going to depend on the type of lender that you're working with. I don't know that this is about like my compensation or where maybe the question is coming from. So please excuse me if I didn't answer that as cleanly as I should have.
No worries. And then I actually had a question on the side. So I think one of the things that you had, one of the questions I was asked earlier, what are the three main questions that get asked of you or that we should be asking? And you mentioned interest rates. So I've always kind of been wondering exactly how are those interest rates calculated and why do they fluctuate on a month-to-month, year-to-year basis?
Great question. Interest rates are going to differ from lender to lender, just as the fees being charged for that given interest rate, as we did that intentionally ridiculous comparison, will differ from lender to lender. Now, at a certain point, if all things remain the same between lender and lender, and there is an interest rate difference, it will come down to risk. So think credit score, think amount of down payment, think payment history, that sort of thing. Interest rate is reflective of risk. So easiest example would be someone with an 800 credit score may see a better interest rate than someone with a 600 credit score. Interest rate is going to be reflective of risk, the true meaning of where the interest rate comes from.
Got it. That is very helpful. Thank you very much, Jake. And then as questions can then obviously come back to it. Shannon, there were a few questions that we had for you as well. So we had someone say that they've always heard that investing is supposed to be boring. Do you agree with this? And then also for 20 to 30-year-olds, do you suggest any more aggressive index funds or kind of maintain being passive?
Okay. Okay. So I just want to make sure I heard you right. So is investing boring? Um, I want it to be for you. It is, and that kind of goes back to that rhythmic cadence that I was trying to recommend. Um, so investing as a professional investor is, I obviously think it's not boring. Every day there is something new, something happens that is changing and keeping the markets dynamic. This morning, the Supreme Court announced that Trump's tariffs are, no longer legal. That has huge implications across consumer discretionary and really across the whole stock market. Is that boring? I don't know, but it definitely is dynamic. I don't want you to think about that though. For you, I would rather it be very boring. I would rather it be opened up once a quarter and say, oh, these are what the funds are doing. That looks great. Or, oh, that's interesting. They're down. Like, I want it to be, and not because I don't think that other people could be investors, but because if you start thinking about investing in the framework that this question is asked, it becomes emotional, and that's when you lose your money in investing. So, yeah, that's kind of what I would say. So investing is not boring. If you look at the volatility of the stock market, it is not. But when you take a longer term framework and you start thinking about your personal finances, we want them to be. Okay. That's the goal. In terms of like positioning, in terms of like what basically what style box do I recommend? So just let me step back a little bit. So when you are thinking about your investments that you can make, right? Like you first start with asset allocation. Do I want to own real estate? Do I want to own investments? Do I want to own private equity? And so you decide, I'm in the equity bucket, right? So you have your equity options. You might have, there's lots of different structures that could look like. So maybe in your 401k, you have a mutual fund, maybe you have ETF options, maybe you have different things. Within that, each one of those mutual funds has a neighborhood that they're supposed to stay in. So my mutual fund is a small cap growth mutual fund. Everything I do is supposed to look at it from that point of view. I say all that to say that I'm in the most aggressive part of the equity market. That's who you're talking to. So I do take an aggressive stance on investments, especially for someone younger who has the time to be long-term oriented. Now, if you come in thinking things are risky and you want to be both aggressive and reactive, I think that's a recipe for disaster. But I guess to step back a little bit, be aggressive, but also be rhythmic in how you approach said investments. Think long term, check on regular cadence. I hope that answered it.
Yes, for sure. And then I'll ask Shannon, I'll ask you one more question, and then Jessi, I'll ask you one more question because I know we're almost out of time. But Shannon, could you share a little bit more about financial manifestation? What does that look like in your life? How should we shape our own vision of financial manifestation going forward?
Oh man. So I don't know if that's an actual financial term. That's a Shannon spiritual financial connection. I don't know what that is. But basically what I'm trying to say is kind of what Jessi alluded to, right? It's so okay, there's two things that happen. And this is true with any goal setting at all. Part of why goal setting is so powerful is just by stating the fact of what you want to do, you are actually taking a step towards doing it. So when you go through the process of financial manifestation and what that looks like for everybody is going to be different, but the process is really the same. Like, what am I building? What is the life I want? And actually, like when you're in the early part of your career or early half of your career, it's kind of hard because you're like, first, I just want to get the job. I want to get my long-term vision is to get the job I'm trying to work so hard to get. So it's hard to think about financial manifestation, but you can step back and say, okay, I know I make $1,000 a month now. I'm just using round numbers. And this allows me to live in this home. Is this the kind of home that would be okay for me in 30 years? Yes or no? okay, I know I want this kind of family structure, whatever that may look like. I want kids. I don't want kids. I want to be married. I want to be single. I want to travel with my spouse all the time. I want to be homebodies and build a little farm life here on some property. Whatever it looks like, take the time to dream about it. You can go all hippy dippy like me. You can make mood boards. You could put up pictures. You can go visit your dream house, or you can keep it pretty simple and say, you know, I want to live this lifestyle that I'm living now, but without having to work in 30 years. And that can get you directionally. Again, it goes back to the basic tenets of goal setting. First, you have to, if you know where you're going, you can get there. The first step to knowing where you're going is finding it on the map or declaring it on the map. And that's kind of financial manifestation. Hopefully that's clear.
Yes, yes. I'm financially manifesting retiring at 35 on a beach somewhere. So
Yeah.
that's
And so,
that's that's
I hope that
that's
you
where
get
I'm at.
there. But even if you don't, you making that declaration and making steps towards that vision is going to set you up really well.
Perfect. Love it. Love it. I'll manifest it starting now. Um, and then Jessi, I will ask one last question and then we'll wrap it up. But you mentioned setting a goal. So even if you don't know if you can reach it or if it's accurate, how can you not feel discouraged and self-critical if you aren't on track to reach that goal?
You need to always be readjusting the goal. So in your 20s and in your early 30s, get directionally correct. I think about it being like, I know I'm here. Let's say I'm in Kansas City and I want to get to San Francisco. I can take a lot of different routes to get to San Francisco, but I need to arrive in San Francisco. And each way along the way, I need to make sure, like, am I still on the right direction to get to San Francisco? But I'm allowed at some point to say, I'm not going to San Francisco. I'm going to go to San Diego and I need to course correct at that time. So it can be so demotivating to think like, okay, I want to retire at 65 or I want to retire at 55 and I'm 30. How do I get there? Right? So you're trying to solve for 25 years. It's too many assumptions. So continue to revisit what is that goal and what am I doing the next 2 years to meet that goal? And then what am I doing the next 2 years? So when I meet with people and we do financial planning, it's not one time. I don't give them a financial plan and be like, see you never. No, we're checking in at least every 6 months, but we're recasting those plans every 2 years.
And Jessi, if you don't mind, I'm gonna add to that. At that annual date that you have with yourself, where you
Yes.
kind of go over your 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 goals, I also very much um believe in make sure you give yourself credit for the things you did over the last year too, right? So make sure we get caught up in, again, it goes back to don't let perfection be the enemy of good. If you didn't save anything, but you paid off all your credit cards this year, you actually made huge progress to your financial security. Or, like, uh, make sure in that annual review process, you say, what did I do well for my future financial self? Because shame goes back to that perfectionism that keeps us from taking steps.
That's awesome. Totally agree. I love how a lot of these topics kind of intertwine with one another. Um, and I'm very grateful for all three of our speakers today. Thank you so much, Jake, Shannon, Jessi, for coming and speaking with all of us today. Um, very insightful topics. I know I learned a lot. I loved having you. I wish we could have kept you all for an hour individually. So this is perfect. Thank you for blessing our Friday afternoons. And then also, as before we conclude today, here is our genKC. The QR codes that we have up are the genKC social medias. Follow us on our socials, our Instagram, our LinkedIn for any potential upcoming events that we may have similar to this. So feel free to scan now. I'll leave it up for just a second. But yes, thank you all so much for joining. Really appreciate everyone attending today's session. And again, thank you to all of our amazing speakers. Really enjoyed having you today and spending some time with us. Also, last thing before we conclude, next week we will be sharing, as I mentioned previously, next week we'll be sharing the tape of this. and then also a few answered questions from some of the unanswered, or some answers to the unanswered questions that were asked in the chat. So those will be sent out next week. So look out for those. But yep, thank you so much, everybody, for attending, and have a great afternoon.